Welcome back to the Deep Dive. Today we're looking inside Errors Management Corporation, and it's quite a story.
It really is.
When you see the headlines for their third quarter 2025 results, the numbers are just staggering. Record fundraising, record deployment, something like $150 billion in dry powder ready to go.
Yeah, massive figures. But there's a kind of paradox here, isn't there?
Exactly. That's what's fascinating.
You have Errors reporting this incredible growth, projecting real confidence, while, the wider credit market is showing signs of stress. There's rate uncertainty, some high-profile bankruptcies popping up.
So our mission today isn't just about listing those big numbers.
No, definitely not. We want to sort of decode the strategy behind it all. What's driving this? How are they so confident about navigating what looks like a pretty tricky credit environment, maybe even benefiting from it?
That's the perfect way to frame it. It's not just about size, it's about resilience. So let's dive into the financials first. They're a key metric for quality fee-related earnings, FRE. What did that look like?
Okay, so FRE came in at over $471 million.
Wow.
Yeah, and that's a 39% jump compared to last year. That's serious growth velocity.
And that really sets them apart, right? Because FRE is profit purely from managing money.
Exactly. It's insulated from the ups and downs of their actual investments. So seeing 39% growth there tells you the core operational platform is humming, expanding efficiently.
And that stability feeds directly into shareholder returns, I assume?
Absolutely. Look at the dividend up to $1.12 per share. That's a 20% increase year over year. And they're not just holding steady, they're signaling another hike is likely coming in early 2026.
Okay, let's talk scale then. The numbers are almost hard to grasp. Total assets under management, AUM, where did that land?
Nearly $596 billion.
Just shy of $600 billion.
And the fee-paying AUM, the capital actually generating those management fees we talked about, hit $368 billion.
Both up significantly year over year.
Both up 28%, consistent growth across the board.
Okay, but here's the structural point you mentioned earlier, the durability aspect. How much of this is locked in?
Right. This is key for the listener. Ours reports that 87% of their total AUM and, crucially, 94% of their management fees come from what they term perpetual capital or long-dated funds.
So, practically speaking, what does that mean if you're trying to understand their business?
It means their core revenue stream is incredibly sticky. It's not going to just evaporate overnight if the market gets choppy or some investors get nervous.
No short-term redemptions wrecking the plan.
Precisely. It's pretty much the definition of durable revenue in asset management. It lets them stick to their strategy, plan long-term, without constantly worrying about outflows.
And there's more fuel in the tank already.
Right.
I saw something in the supplementary data about committed capital that isn't even paying fees yet.
Yes, $81 billion. That's committed AUM that hasn't been deployed.
So that's basically future revenue already guaranteed.
Essentially, yes. As they put that capital to work, it automatically converts into fee-paying AUM. This means their management fees are set to accelerate even without raising a single new dollar. It's a powerful growth engine baked right in.
Okay, let's shift from the balance sheet strength to fundraising. This quarter was huge.
It was monumental. Over $30 billion raised in Q3 alone.
Their highest quarter ever.
By far. And if you look at the last 12 months, the total is over $105 billion raised.
They're basically on track to smash their own records again.
Yeah, they explicitly said they expect to meaningfully exceed last year's annual record, which was $93 billion. And it's coming from multiple areas.
Like what? Any specific examples stand out?
Well, infrastructure is one. They just had the final close for their third infrastructure secondaries fund.
ISIS there.
That's the one. Closed at $3.3 billion, which was actually above their hard cap. And that fund is 3 times bigger than the previous one.
Wow, 3 times. What does that tell you?
It tells you institutions are really looking for ways to manage their existing private investments, gain some liquidity maybe. There's huge demand for these secondary strategies. Overall, they pulled in $10 billion just across infrastructure in the last year.
And credit obviously must still be a big draw.
Oh, absolutely. $19.3 billion raised just in credit strategies this quarter. Demand for private credit remains incredibly strong.
Now, what about the wealth channel?
Oh,
We hear so much about tapping into high net worth individuals as the next big growth area for alts. How's Ayers doing there?
they're really hitting their stride. Q3 saw their highest ever quarterly equity inflows from their wealth platform.
How much?
$5.4 billion. That's up more than 70% compared to last year.
70%. That's huge acceleration.
It is. And their market share in that specific semi-liquid product space actually topped 10% in the quarter. That puts them #2 in the industry for fundraising there. They're gaining serious traction.
And they're clearly bullish on it continuing. They raised their targets quite a bit.
They did. The 2028 AUM target for these wealth products is now set between $100 billion and $125 billion.
That sounds incredibly ambitious.
It's definitely ambitious, but their argument is that this whole shift of private wealth portfolios into alternatives is still, as they put it, in its early innings.
So a huge untapped market still.
That's the bet. Think about it historically. Private markets were mostly for big pensions, sovereign wealth funds. Now, with more accessible products, the potential pool of global wealth is just enormous. Iris clearly thinks they've got the structure and distribution to grab a big slice of that.
Okay, let's pivot. Fundraising is one thing, putting the money to work is another. Deployment was also way up, right?
Way up. Over $41 billion deployed in Q3. That's a 55% jump just from Q2.
55% quarter over quarter. What does that signal about the market?
It signals things are definitely heating up. Iris said they're seeing a pickup in underlying M&A activity. They expect strong deal volume to continue through the rest of this year and into 2026.
So the logjam is breaking. Buyers and sellers are finding common ground again.
It seems like it. That bid-ask spread, the gap in valuation expectations that stalled deals, seems to be narrowing. That unlocks deployment.
Which brings us to interest rates. It's the big question everywhere. If rates do start coming down eventually, how does a private credit giant like Ares see that playing out? You might think lower rates mean lower returns for them.
Yeah, it's a bit counterintuitive, but Ares actually views potential rate cuts as a net positive, a tailwind for their business.
How so?
Well, historically, they've seen that lower short-term rates tend to encourage more deal activity. Corporate sponsors are more likely to transact, use debt financing, which means more deployment opportunities for Ares.
Okay, that makes sense for volume. But what about the returns themselves?
Crucially, in private credit, lower base rates often lead to credit spreads widening relative to public markets. So the all-in return on their direct lending can actually become more attractive compared to other options, even if base rates fall.
So potentially more deployment and attractive relative returns.
That's their view, supported by history. It draws more capital in, accelerates their fee-paying AUM growth.
Did they give any color on where they're deploying in real assets specifically?
Yeah. They mentioned seeing valuations firming up in logistics and multifamily real estate. Those continue to be core areas.
Still seeing green shoots there.
Exactly. But the really big push they highlighted is infrastructure, specifically digital infrastructure, data centers.
That seems to be a hot topic everywhere.
It is. They noted demand is just massively outstripping supply. Vacancy rates are at historic lows. So that's a huge focus for their real assets deployment right now.
Okay, this leads us nicely to the core issue, credit quality. You started by mentioning their confidence despite market jitters.
Right.
But you can't ignore the headlines about debt stress, potential slowdowns, those specific company failures we've seen. How does Ares justify saying these are just idiosyncratic one-offs and not the start of a real downturn?
This is where they get really granular with their own data and track record. They essentially say, look at the numbers over the long haul. Their headline stat is that their net realized loss rate in direct lending over 2 decades is just 1 basis point.
1 basis point. Okay, put that in perspective for us. Why is that so low?
Well, 1 basis point means for every $10,000 they've lent out over 20 years, they've ultimately lost only $1 on average annually. In the world of lending, especially leveraged lending, that is exceptionally low.
How do they achieve that?
They point to their underwriting discipline and deal structures. Primarily, over 93% of their credit exposure is senior debt.
Meaning they're first in line to get paid back if things go wrong.
Exactly. That seniority provides significant protection.
Okay, that's the track record. But what about the portfolio right now? How healthy is it today?
They gave specific metrics there too. For example, ARCC, their big publicly traded BDC.
Ares Capital Corporation.
Right. Loans on non-accrual, meaning loans they don't expect to be repaid in full, stood at only 1.0% measured at fair value.
And how does that compare historically?
That's actually 100 basis points below ARCC's own long-term historical average. So by their own benchmark, the portfolio is currently performing better than usual.
That's a pretty strong internal comparison. What about the buffer? If the economy really tanks, how much cushion do they have in these loans?
That comes down to loan-to-value ratios, or LTVs. They stated their LTVs are conservative around 42% in the US, 48% in Europe.
So explain LTV simply.
Okay, think of it this way. For a company they've lent money to, its total enterprise value would need to drop by more than over 50% before heirs would even start to lose principal on their loan.
That's a significant margin of safety.
It is, and that's why they feel insulated against just general economic softness. It would take a very severe hit to the underlying businesses to cause them major losses.
So connecting the dots. If a real credit cycle does hit, what's their play? They've got this massive $150 billion war chest of dry powder.
Right. Their fundamental belief, backed by past cycles like the GFC in 2020, is that market stress is actually an opportunity for them.
An opportunity. How?
Because their business model is centered on management fees, not taking credit losses directly onto their balance sheet in the same way a bank would. That shields them. And crucially, when markets get dislocated and capital becomes scarce,
They can step in with that huge pile of dry powder.
exactly, they can deploy capital into deals with potentially better terms, better pricing, maybe distressed situations, capturing what they call superior vintage returns when others are forced to pull back.
So they actually see market dislocation as an accelerant for their fee growth.
That's precisely their argument. They
Yeah.
highlighted that during the GFC and the 2020 downturn, their management fee growth actually accelerated, compounding at 27% annually through those periods. Dislocation isn't a threat to the core model, it's fuel.
Okay, interesting. Let's broaden out a bit. Beyond just lending, they're clearly diversifying. Talk about the real assets platform growth.
Yeah, that's been a huge focus, especially after acquiring GCP International. That deal really scaled up their real assets capabilities.
The numbers show it.
Dramatically. Real assets, AUM, and fee-paying AUM are up 88% and 87% year over year, respectively. Huge jumps. And their strategy there is very focused, vertically integrated operations in specific sectors they like, such as industrials and residential.
And you mentioned data centers earlier. Are they just buying existing ones? Or
Yeah. No, they're actively developing. They mentioned having about $6 billion worth of land banked specifically for data center development.
$6 billion. That's a big commitment.
It is, and they're focusing on sites that are close to urban centers designed for low latency performance. It's a very strategic, forward-looking play on the whole AI and digital infrastructure boom.
Makes sense. And any other strategic moves? M&A, perhaps?
Yes, the Blue Cove acquisition is significant. They're taking full ownership of this systematic investment-grade credit manager.
And why is that important?
It's expected to close early next year, and it adds a really important capability, particularly for their affiliated insurance platform. Insurance companies need vast amounts of investment-grade credit assets, and Blue Cove gives Ares sophisticated tools to manage that effectively. It's a key value add for that large, growing pool of insurance capital they manage.
Got it. And one last thing before we wrap up. They mentioned a charitable initiative.
Yeah, quickly, it's worth noting they have this Promote Giving initiative. Certain Ares funds, like their Pathfinder series, actually pledge a portion of their performance fees.
So a slice of the profits.
Right. Pledged to charities focused on global health and education. They said they've already accrued over $45 million in these pledged contributions. It's a pretty substantial commitment alongside the business itself.
Okay, so let's try to synthesize this. What's the big picture from this deep dive?
Well, it paints a picture of an alternative asset management giant that's built an incredibly robust business. It's structured around those durable management fees. It's successfully tapping into massive global investor demand for private markets.
And it's operating with this really strong conviction in its own underwriting and its ability to navigate potentially rougher waters ahead.
Absolutely. I think the key takeaway for you, the listener, is this idea of structural resilience. Ares isn't just aiming to survive market stress. Their model seems designed to actually thrive on it.
Because of that dry powder and fee focus?
Exactly. That huge amount of available capital allows them to turn market dislocation, the very thing that can cripple traditional banks or more levered players, into an accelerant for their own growth, their own fee generation.
That structural advantage is really striking.
Yeah.
Ares was quite explicit, wasn't it? They said if your credit cycle hits, they expect to see strong growth again by deploying that capital when others can't.
They did. They see it as a predictable pattern based on past experience.
So here's the final thought to leave you with. Given everything we're seeing, the pockets of volatility, the underlying uncertainty is a firm whose business model seems to actively benefit from scarcity and dislocation. Is that becoming the defining model for the future of asset management? Something to think about until our next deep dive.